Hi, this is Jim Lang. What is the problem or the biggest financial problem for IRA and retirement plan owners, and particularly IRA and retirement plan owners that have $1 million or more in their IRA or their retirement plan? The biggest problem is current and future income taxes. Because remember, and when I say retirement plans, I'm including IRA, 401k, 403b, SEP, KEO, etc. What all of these types of plans have in common is that nobody has yet paid income taxes on this money. And when you take this money out, either because you're doing it voluntarily or because you have to through a required minimum distribution, or your heirs have to after you're gone, there will be income taxes on those distributions. And for people who have very significant IRAs and retirement plans, there will be very significant taxes. On the other hand, there's an enormous difference between the amount of taxes that you will pay, which translates into your and your family's financial security, using the best strategies versus either no strategies at all or less than optimal strategies. So that is what we are going to talk about. And one of the problems that IRA owners have, we've always had this problem of income taxes on the IRA and retirement plan, both while we are alive and after we're gone, but it is so much worse now, partly because of the Secure Act, and we're going to dig into some of the details and of the Secure Act, and also because of the dramatic income tax rates that are pending. So we're going to be covering what I would call the living strategies. These are things like Roth IRA conversions and things that are not directly related to wills, trust, state IRA beneficiary designations, etc. Of course, the truth is retirement and estate planning is one continuum, but we're going to be covering, just to make it a little bit easier, some of the living strategies. Then we're going to be switching over into what I call the dying strategies, which we call the best estate plan for IRA and retirement plan owners after the new administration, referring to the income tax increases. But again, this is a continuum. Retirement plan, estate plan. It's not, okay, retirement plan, okay, now let's start all over. Now let's do the estate plan. It is really one, which is one of the advantages of going to a multidisciplinary practice like ours, because we do incorporate both retirement and estate planning as one continuum. Okay, the other theme that we're going to address is shifting at least a portion, hopefully a lot, of our money from the taxable environment to the tax-free. So what do I mean by that? Well, the tax environment is, again, IRAs, 401ks, 403bs, etc. You're going to have to pay income tax. Maybe your heirs are going to have to pay income taxes on the distribution of that money. What if we can shift some of that money to the tax-free environment? What do I mean by the tax-free environment? Roth IRA conversions grow income tax-free. After-tax dollars, with the exception of the interest, dividends, and capital gains, are tax-free. Cashing in IRAs and retirement plans and gifting the proceeds for a 529 plan, which is probably consistent with your values, which is typically for education of your grandchildren. Life insurance, having your heirs put money in their Roth IRAs and doing Roth IRA conversions themselves. These are just a couple examples of going from the taxable environment to the tax-free environment. All right, so what are some of the critical bedrock foundation stone, if you will, strategies or principles for IRAs and retirement plan owners? And I'd like to, let's say you can summarize that in one sentence, which is, and if you've known me before, you know I've been saying this for over 20 years, don't pay taxes now, pay taxes later, except for Roth IRAs and Roth IRA conversions. I'm going to say that again. Don't pay taxes now, pay taxes later, except Roth IRAs and Roth IRA conversions. Jane Brian Quinn wrote an article that has some of my strategies And she called that my mantra because it was so important. And interestingly enough, this principle, don't pay taxes now, pay taxes later, this applies in the accumulation stage when you are working and you're putting money in your retirement plans and preparing for the day that you will no longer be receiving a salary and that you'll be getting into what is called the distribution stage. So during the distribution stage, you are alive, you are no longer working, or at least no longer working full-time in the capacity that you either maybe now or did at one point in your life. What are the best distribution stage strategies? Surprise, surprise, surprise. Don't pay taxes now, pay taxes later, except for the Roth. And this bedrock principle even applies after you're gone. I want your heirs to not pay taxes now, to pay taxes later, except for the Roth. And we're going to get into how you can help effectuate this foundation stone strategy into your own retirement and estate plan. Now, to be fair, there is this little glitch of where there is an exception where sometimes I sit before the exception to don't pay taxes now, pay taxes later was Roth IRAs and Roth IRA conversions. We might want to expand that exception to paying taxes now and then gifting money that will go in tax-free vehicles like 529 plans, life insurance, and your heirs' 401ks and 403bs. Again, the overriding principle, don't pay taxes now, pay taxes later, except for the Roth IRA, Roth IRA conversions. Few of these other little exceptions, but that will apply in the accumulation stage, the distribution stage, and in the estate planning stage. And you might say, well, gee, Jim, is there really that big a difference, particularly after I'm gone? So I know after I'm gone, the old rules were I could stretch the heirs, that is the non-spousal, most likely children or grandchildren, heirs of the IRA or retirement plan had the ability to stretch or to some extent defer income taxes on their IRA or their retirement plan. Under the new law that was effective for people dying after, on or before January 1, 2020, the heirs are going to have to pay, subject to exception, the most important of which is the surviving spouse, by the way, but subject to exception, the heirs are going to have to pay income taxes on the inherited IRA within 10 years of your death. Okay, well, gee, what's the difference between, let's say, a 45-year-old inheriting $1 million under the old law and inheriting $1 million of IRA money in the old law versus the new law? You think, well, gee, how much difference can it make? Because the only difference, they're going to have to pay taxes on the whole thing. In one, they have to pay taxes in 10 years, which is the new law. The old law was, to some extent, stretch it and defer it over their lifetimes. And what you see in the slide before you is you have, let's say, Mr. Green, who died with $1 million. Maybe he died on December 31, 2019, and given certain reasonable assumptions, the green line is showing where Mr. Green's heirs would be. And that even includes the additional spending from the inherited IRA. And you will see that when the children of Mr. Green, that is, if we're going to analogize it, that would be your kids, when they're in their mid-80s, given these reasonable assumptions, they would have over $2 million. But under the current law, instead of your heirs having $2 million towards the end of their life, they would be broke, that is zero. So this is important stuff. And we can never quite get you to where the old law was, but there's a lot of things that we can do to mitigate so that your heirs will not be at zero. They will be somewhere in between the 2 million and the zero. And this is really critical to get this right, to help you and your family get the most out of what you've got.